Good morning. This is Dylan Jovine with Behind the Markets. Happy Tuesday. Today is Tuesday, May 20th. And today I'd like to talk about Moody's downgrade of U.S. debt. It's a big deal. The U.S. Treasury now, for the first time in our history, carries risk. We downgraded from AAA to AA1, which means that actually people who buy U.S. Treasury bonds from the U.S. government now should consider them to carry some risk. This is a big deal. They're basically saying the U.S. can default on its loans, even though it wouldn't be a default as you imagine it, where you just stop paying. It would be a default. The kind of default we would see would be printing so much money as to degrade the value of whatever bond you have. That coupon that you're getting paid every year would just get smaller and smaller. So what we've seen in the markets yesterday basically was the 30-year bond rallied at 5% yield, which is a big number. And the 10-year note ran up to 4.5%, which again, remember, stocks and yields trade in inverse relationship. They have a seesaw relationship. Yields go up, stock market goes down. Yields go down, stock market goes up. So basically, what you have to watch out for, what we have to watch out for, is the fact that we're looking at a situation here where the market now is going to be determined, where the stocks go will be largely determined by the 10-year, the Treasury yield, which actually, as of right now, this morning is 4.55%. That's going to keep a ceiling on stocks for the time being. So it seems that the bond market is in control. And I really, the fear here is that we don't take paying back our debts so seriously, that the U.S. government spends so much money, runs such big fiscal deficits, that we're basically saying to anybody who buys our bonds, look, that 4.5% we're paying you right now, it might be worth nothing if we keep printing money. So people are really starting to look at U.S. treasuries in a very different way. Now, for its part, the Trump administration, Treasury Secretary Scott Bessent said the other day, it's a backward-looking indicator, meaning that Moody's is talking about something that's already happened. And of course, what's he going to say? But this has real ramifications for the role of the U.S. dollar as the world's reserve currency. It has real ramifications for a whole bunch of things. And it's really interesting. This kind of ties in. What I've been thinking about here is the Weimar Republic, Germany, pre-World War II. You had a situation where inflation got so bad that individual cities started to print their own currencies based on the copper or the gold, the copper leaf in the buildings or the lead pipes. They would actually pull it out of their buildings. Crazy stories when you read about the history of this. And they'd say, we're going to back our currency by this asset. So it's really astonishing how well they really started to break off. The country started to break off into little sections, little cities, little areas where each one was issuing its own currency. And, the setup for that, the infrastructure to make that happen is already starting to happen with crypto. When we read Arizona is launching its own stablecoin and all these other little crypto things are launching, states are considering launching their own cryptocurrencies. We're at an interesting time in American history where other countries look at us and say, they don't even trust the US dollar and trade with it. Why should we? When our own government supports basically crypto over the US dollar, you're basically telegraphing to other countries, why would you trust the US dollar? Why not just trade in this currency or that currency? This is very harmful. I'm not sure that the people who are doing this, I think the people doing this really are looking for political points. I'm not sure that they're serious about power and they're serious about understanding how these things unravel through history. I'm not sure there are any historians that are making decisions like this, because all it does is really hammer the U.S. So let us hope that President Trump and the Republicans that are running Capitol Hill right now come with a more sober, responsible budget. Because I'll tell you something, the thing that could make this stock market take off like crazy, just like during the Clinton year, the thing that can make this stock market take off like crazy would be some kind of balanced budget or something more balanced, something not just red ink heavy. You remember during the Clinton years, anybody tells you the balanced budget's terrible. You remember during the Clinton years, he balanced the budget. The government did not have to borrow money from the bond market anymore. All that excess money that would have gone into U.S. bonds poured into American business. So it's a real big way, poured into the stock market. So it's a real big way. Clinton was the last president to do this. Don't let anybody tell you that Democrats can't get their stuff together from time to time, because he really balanced the budget and left us with surpluses, literally by surpluses, government surpluses. And all that surplus money, all the money that the bond investors would have spent on U.S. debt went into the stock market, and we had the 90s boom. You remember that. Let us hope that the people running our country today can hearken back to a lesson just 20, 25 years old and really get it together, because they certainly have knocked the size of the government down back to 1990, mid-90s levels, and which I'm happy about. So let's see if they could really bring some fiscal discipline to the rest of the process. And if that happens, the stock market's going to take off. If it doesn't happen, yields stay high, putting a ceiling on the stock market at this point until the narrative changes. Anyway, that's all I have for you today. Have a wonderful day.